All right there, finance friends, welcome back. In this part of the course, we're now moving into what most people typically think is financial planning, even though we know there's many parts, but we're moving now into the topic of investing. Within investing, there's a lot of different things to cover, including general principles, but mainly including the different types of investments you can make. In later lectures, we're going to cover individual vehicles, aka asset classes. So we'll discuss stocks in some detail and bonds and mutual funds, things like that. But in this video today, what I want to offer you is just a bit of an introduction to investing, sort of a principles-based, very broad umbrella, an overview, a bird's eye view of what investing is, and some of the things that you should keep in mind, both as you go through the next couple of weeks in class, but also as you look ahead, decades down the line to future you and to where you want future you to be. So let's jump in right now. And again, this video today is just going to be kind of a broad one, very umbrella, top level. And then later on, we'll get into more specific detail about stocks and bonds and other tools that you can take advantage of, okay? Let's jump in. And let's start with some definitions. While the term is used in different ways by different people and means many different things to many different people, let's say, for our purposes, that investing can be defined as the process of placing your money into some particular medium, some particular tool, some particular asset type. That can be stocks, that can be bonds, it can be mutual funds. You can go into the real esoteric things like commodities or gold or precious metals or options trades. But broadly speaking, investing is simply putting your money into some sort of medium, and critically with the expectation of receiving some future benefit. So you're putting money away now to gain in the future. To put that in some of the jargon that we've discussed earlier, you are making sacrifices today for future you. So you can also think of investing, if you look at it kind of from a narrative arc and over your lifetime, you can think of investing as the rewards that you get for sacrificing consumption today for consumption in the future, okay? Taking some hits, some small financial sacrifices today so that future you has a big pool of resources from which to draw, okay? When we talk about investing, we are assuming critically that we are talking a long-term perspective. And by long-term, we're talking decades, especially when it comes to your 401ks and your IRAs. Those kinds of long-term retirement plans are truly long-term. We're talking a decades-long perspective, not weeks, not months, not the latest economic cycle, not the latest earnings report on Wall Street, but decades of disciplined, systematic thinking, okay? Now, while investing is assumed to take a long-term perspective, speculating, in contrast, is not investing. You can consider speculating to be a very short-term process of buying and selling securities, but critically, when it comes to speculating, any kind of future value and expected returns are highly uncertain. Now, people would say that there's no certain returns in investing, and that is true. However, there are historical trends, and therefore we can say, not with complete certainty, but we can say with a relatively high degree of certainty that if you start young and have a long-term investment program, you can use some historical data to predict, and again, not perfectly, but to make predictions about your long-term returns based on certain asset classes. With speculation, those returns are highly uncertain, highly volatile. Now, one big thing that we have to do is we have to put investing in the context of your broad personal financial plan. You know that your personal financial plan includes many components tied to things like cash management and tax management, credit management, the purchase of big assets like cars and homes, all these different pieces that play into this big puzzle, this big mosaic. But investing is a critical part of it, because at the end of the day, most people who have financial goals, they cannot afford to pay for those goals in cash out of their reserves right now. Most people who have aggressive, meaningful financial goals at the present moment cannot afford to pay for those in cash. And as a result, the achievement of your long-term goals, the ability for future you out there in that distant future, the ability for future you to hit those meaningful goals, to achieve your life vision, to live the life that you want to live, to flourish like you're meant to flourish, you're going to need to accumulate funds over time. It's investing that allows you to grow your asset base and in turn live the great life that you deserve by being able to afford your financial goals. Okay. Note, of course, that as in all aspects of personal financial planning, as I lay it out to you, goals are central. What are some of the common investing goals that people have? Well, there's a lot. And the ones I'm going to share with you are pretty general, pretty generic. Most people have them at some point. But of course, your job for you as an individual is to take a look at your life vision and your mission, where you are in your life cycle, where future you wants to be, how you want to be remembered, and design your goals appropriately and personally. But for some guidance, common investing goals include some of these: buying a home or a vehicle, building a retirement nest egg so that you can have a great life and make a difference in your loved ones' lives, children and grandchildren, for example, when you're retired, as opposed to eating cat food because you have outlived your money. So buying a home or a vehicle, building a retirement nest egg, paying for a child's education. Maybe it's your own child, stepchild, godchild, grandchild, niece or nephew, but the ability to give back and the ability to give this next generation the same awesome Zoom University experience that you all are getting right now, that's really important. So paying for kids' education. Some of you entrepreneurs, you're going to want to accumulate startup funds. You're going to want to take some vacations, perhaps. And critically, ultimately, I think that a fantastic financial goal and a fantastic investment goal is reaching financial independence. Now, there's a lot about this right now. There's a whole school of thought called, FIRE, F-I-R-E, financial independence, retire early. Everybody has their own different views on what constitutes financial independence. For some people, it's simply saying, I never have to worry about money again. And that's a great feeling, not having to worry about money. Other people take a bit of a more technical approach by, for example, saying that financial independence to them might mean that their returns on their investments, so that kind of passive income of stock dividends and interest, for example, can cover their monthly expenses. So in other words, if you get to a point where you do your personal financials and you say, I need $4,000 a month to get by because that's my monthly expenditure, you might define financial independence as my investments generate $4,000 per month of passive income in terms of dividend income or capital gain income, stuff like that, okay? Interest income, rental income. Anyway, however you define it, those are some common personal financial goals. And as you know, once you have your goals, once you've listed them and thought through them, then you can apply the process of prioritizing them, putting them on time frames, and then putting together strategies, including the use of investment tools to help you achieve them. So investing is an important way to think about your financial future, and it is going to be an important part of your ability to hit your financial goals. I want to point out, in terms of straight definitions, that investing is distinct from saving, okay? Savings is the accumulation of excess funds by intentionally spending less than you earn, as I have harped into you guys over and over again, okay? So saving is making appropriate and informed budget decisions to spend less than you earn to accumulate excess funds. Investing takes some of those excess funds and deploys it so that you can make more money, okay? So you need savings to do investing. Notice again here, as in every other part of personal financial planning, as I like to share it with you, you see the importance of operating cash flow positive. You see the importance of spending less than you earn, and hopefully you see the importance of building systems. Systems that allow you to accumulate savings over time. Now, once you're into this game, you will see that when you invest, you have a variety of investment vehicles, the fancy term being asset classes. So investment vehicles or asset classes where you can put your money in order to meet your investing objectives. One of the big parts about investing is understanding how the different asset classes behave, because each one has particular risk and return characteristics. And as we'll learn in detail when we talk about individual investment vehicles or asset classes, it's that risk return trade-off that's really important in you deciding which asset class to invest in at which part of your life. It's also worth noting that there's a risk return relationship. And the general rule that we expect in personal finance is you have to accept higher risk in order to generate higher return, okay? And there's reasons for this, which we'll discuss later, but just know that there is a risk-return relationship. You want big returns, you need to take on a bit more risk, sometimes a lot more risk. Ultimately, the asset classes that you deploy your money into will help you to determine, or at least help you to kind of look at and measure your risk and return characteristics. What are some of the most common asset classes that people invest in? There's a handful. Most common one, cash and cash equivalents, bonds, stocks, and mutual funds. Note that each of these is technically an investment. Lots of people will say, well, wait a minute, my money in a CD or my money in an online savings account, that's not an investment. It technically is, because it is excess funds. You are deploying it into a particular medium, and you do have an expectation of future return. Now, today, if you put your $98 of savings into your Bank of America savings, you're not going to get much return. But technically, since you're not consuming the money by spending it today on stuff, since you are holding it for future use, you are deploying it into a medium. So we can consider cash and cash equivalents, bonds, which are also known as fixed income investments, stocks, which are technically called equities, because they represent an ownership stake in the company, mutual funds and ETFs. All of those are common asset classes that typical investors put their money in. You also have the asset class known as real estate, for example, investing in rental properties. Those are some common ones. There's lots of other asset classes. The ones, though, that are not mentioned here tend to be a little bit more esoteric, a little bit more technically complicated, a lot more volatile. So things like currency markets or gold and commodity markets, futures and options, and all of those tools, those are also asset classes. But the 5 that I've given here are the ones that most investors can find themselves to. And that's not a bad thing, because you can do really well with proper selections from those 5 asset classes, okay? When it comes to investing, ultimately, what you're looking at is your return. So let's talk about that briefly. Your return from investing will typically come from 2 sources. The first source will be what we're going to call current income. Current income is the money that you receive while you own an investment. So the interest on a CD or savings account, the rent that you pull in from a rental property you own, dividends from the stock or mutual funds that you own. Those flows of money in will be called current income. The second way that you can get return is through capital gain. Capital gains are effectively the increase in an investment's value that you would realize upon selling it. Capital gains are typically calculated as the sales price of an asset minus the cost and fees that you pay. And this is going to come back in a big way. Cost and fees are really important, and maintaining and controlling them is one of your financial responsibilities. But anyway, your capital gain is calculated as your sales price minus the price that you paid for it. Again, reduced by purchase transaction costs. The rate of return of an investment, which is also known as a yield, is simply its total return, including your dividends and capital gains, as expressed as a percentage of the price, and typically calculated on an annualized basis. Okay. Now, here's the thing, my friends, there's a lot going on here. And the thing that I want to encourage you, both in today's video and in the future discussions on this topic, do not be overwhelmed. Do not be intimidated by investing. Okay, you can do this. Getting started is not that difficult. You have everything that you need in terms of the mental capacity and the drive and the access to tools to do this. So don't be afraid. Don't be intimidated. Don't think that you can't handle it, okay? Don't self-inflict a wound on your financial future by thinking that this is beyond your scope, okay? You can handle this. And remember, ultimately, the key to long-term wealth creation is to start early. So you really want to make it a point to learn these principles, to study these chapters, to do some reading on your own, to not be intimidated, okay? You can do this. Because really, if you really want to put it in like this basic core, learning about investing is simply learning how to think through and critically answer 6 questions. Investing is about asking yourself, what are financial markets and how do they operate? What are the major financial instruments, the asset classes, and critically, what are their advantages and disadvantages and risks? What are the asset classes and why are they important? That's tied to that one. What is your particular asset allocation and how will it change over time? Meaning, of all those asset classes that are available, how will you choose to deploy your investing resources? What percentage of your investments will go to each asset class? That's called your asset allocation. And that's a really important decision because of both the risk-return ratio, or the risk-return relationship. It's not a ratio, but the relationship, and also the fact that as your life cycle emerges, your needs change and your asset allocation will change. Typically when you're younger, you have a lot more time ahead of you to absorb the market's risk and volatility. But as you move closer to retirement, for example, or as you move closer to reaching and getting near a financial goal, you may need to reduce your risk exposure. And you do that by shifting away from riskier assets to more stable assets. Of course, by doing that, you're also inherently shifting away from potentially higher return assets to lower return assets, okay? But again, understanding that is just one of the big financial tasks ahead of you. What is your personal investment plan and how will you invest? And finally, over time, how will you build your portfolio and how will you monitor it? Will you have cash flow positive so that you have every month or every year a chunk of money to add to your portfolio? How will you seed it? How will you build it? And as time goes on, how will you monitor it? Okay. So again, I want to encourage you to not be afraid of this stuff. You've got this. I also want to encourage you, though, that before you begin an investing program, and I do think it's worth starting early, okay? The time value of money rules that we've learned, they suggest that if you start early, you're going to be richer in the future. So don't be afraid. Don't be intimidated. Make a plan, start early. However, I do think you have to be prudent. And therefore, I think that you should ask yourself, I would advise that you ask yourself several questions before you start investing. And these are really more to kind of ground yourself and to really make sure that investing is the right thing for you at this particular time in your life cycle, okay? What are some of the questions that you should ask before you start investing? Well, they're really tied to making sure that you have a sound financial base. You know, the basic idea here is you have no business investing, with a few small exceptions, which we can discuss. But broadly, you have no business investing unless you've got a firm financial foundation. Right? How's that for alliteration? A firm financial foundation. Okay. And what does this mean? Well, here's some questions. You know, number one, are you currently paying all your bills and all your credit cards in full every month? In other words, do you have control of your budget? Are you generating net cash flow positive in that budget? Do you have your emergency fund, your oh shit fund, sufficiently filled? In other words, do you have the liquidity to get you through some sort of personal or financial or professional emergency? Is your insurance coverage adequate? Do you have all your assets covered, having thought through a comprehensive insurance plan? If you're working, so if this is applicable, are you already contributing the minimum amount that's needed to your 401k or 403b plan in order to get that crucial free money known as the employer match? And finally, from a straight behavioral and mental perspective, are you willing to make sacrifices today to benefit future you out there? If you answered yes to these questions, or if you will soon be able to answer yes, because some of them might be in your medium-term future. If you answer yes to these things, or you're soon able to answer yes, then my friends, I encourage you, don't delay, do your research, set your goals, write out a personal financial plan, and jump in, okay? You can handle this. Let's take a next step forward, and let's assume that you are going to begin investing. Before you begin investing, I would advise you to prepare what I would call your personal investment plan. Almost every company, right? Every for-profit and nonprofit company that deploys capital into investments, they have written investment plans approved by their management, approved by their board of directors, that lays out a philosophy, a set of goals, but critically, a set of self-imposed limitations that shape that organization's investment choices. This, to me, is a practice that every individual investor, that's me, that's you, should do. In other words, I need to think of myself as Eric Incorporated, and you need to think of yourself as you Incorporated. And we should follow this prudent practice that other companies follow and create a personal investment plan. It sounds complicated. It's really not. It's simply a statement, which should be written, by the way, because if it's in your head, it doesn't mean anything. It's got to be on paper. Okay. You have to put the time into writing it, drafting it, refining it, thinking through it. Okay. But basically, your personal investment plan, it's simply a statement that explains your investment philosophy. And critically, it outlines the systematic routines that you will follow in order to reach your goals. In other words, Your investment plan can be seen as a way of translating an abstract vision into a specific set of strategies. Your investment plan is a way to get from the dreams that are floating around in your head to a reality in your financial future. And I want to assure you, and I hope that you trust me on this one, learning the ability to map out a plan is the surest way to achieve success in any part of your life. Because the reality is, lots of people dream things and lots of people visualize things and lots of people wish for things, but very few of them achieve those things. Learning how to commit your goals to paper and then learning how to develop a systematic plan to get there is what will separate you from the others. And I want you to achieve your goals. I don't want you to think about them and set them. I want you to reach them and flourish. So I encourage you to put together your investment plan. Now, you might be thinking, I don't have time for another plan or another thing. Well, it's not that bad. You can knock this out on one single sheet of paper if you choose to. It's just got a few components at minimum. You can add more if you want, but at minimum, your investment plan has simply a couple of questions that you need to answer. One of those questions, what are your risk and return objectives? And in this question, we get to the idea of the risk and return angle of investing, okay? Because ultimately, your expectations of how much you want your money to grow, which will be constrained by your threshold for risk, those will determine in large part your allocation, and will determine in large part which of the goals that you set will be feasible and which ones may not, okay? You're not gonna earn 30% per year in a safe investment. So if one of your goals requires 30% per year return in order to fund it, then you've got to do some critical thinking, okay? But your first big question, what are your risk and return objectives? Fundamentally, all investors face a trade-off between risk and return. This is because all investments carry risk. And as we said earlier, the higher the risk, the higher the associated return that goes with the investment, because most investors require more return to offset risk. The flip side of that also holds true. If you want a high return investment, if you want to grow your money more aggressively, you have to be comfortable with more risk. And this is where we get to the idea, as a part of this first question, and as a part of your financial plan, of really thinking through your risk tolerance. Are you a conservative investor? Are you an aggressive investor? Are you a moderate investor? And there's a few tests that you can do, real simple ones that we can do when we're lifetime together, that will give you a sense of your risk thresholds and your sense of, in behavioral economics, loss aversion, to help you understand really how willing are you to handle the changes, to handle the volatility in your portfolio. A real quick note on risk. In investment theory, your expected return is composed of two elements. The first one is known as the risk-free rate of return. This is the return, as the name says, this is the yield that you could be expected to get on a totally safe investment. Now, you may argue that philosophically there are no totally safe investments, fair enough, but in the world of practical day-to-day investing, we search those out. The benchmark, the typical epitome of the risk-free investment is the United States short-term treasury bill, AKA the T-bill. So the T-bill, the short-term treasury bill's rate of return, its yield, that would be the risk-free rate of return. And then what you do is you simply add to that what is known as the risk premium. And the risk premium, which is also known as the equity risk premium, this is the additional return that you require to offset the different risks that are associated with your investment. So it's the risk premium that helps to put some numbers behind the risk return trade-off and the risk return connection, okay? So anyway, you have one first question. What are your risk and return objectives? And what is your risk tolerance? That's your second question. What is your investment personality? What's your risk tolerance? It's really important here that you're honest with yourself. If you're risk averse, if you're more conservative, if you have a very, very high aversion to loss, there's nothing wrong with that. That's part of who you are. But acknowledge it, accept it, embrace it, and critically factor it into your investment plan. Some of you may be more aggressive investors for whatever reason. And there's evidence that it could be social, cultural, biological, neurological. There's lots of different mechanisms that may make one person more or less risk averse. Maybe you're an aggressive investor. That's okay too. But you have to factor that into your plan. A third question that you want to incorporate into your investment plan: are you going to use active or passive strategies? Active investing, okay, the term active investing, this is basically like what day traders do, right? Or people similar to day traders. Active investing refers to the process by which individual investors will carefully study market trends, they'll follow the macroeconomy, they will look at all these different investment alternatives, and then critically, they will make relatively frequent buy and sell decisions, okay? Some people do okay at this. You know that I love you, so I'm going to tell you something honest and probably true. Those people aren't you. Active investing is very hard. And honestly, you probably will not be good at it. I don't say this to insult you. I say this because of the research and the mathematics behind it. They say that investment professionals, these are professional investors who do it for a living. These people, by the way, put way more time into these things than you do. They have higher knowledge than you do. The stakes are higher for them. Professional investors underperform the market frequently. So the idea is, if a professional who has got major info advantages over you, if they're not outperforming the market consistently, mortals like you and I have little chance. So active investing is very hard. What's the alternative? Well, the beauty of passive investing. Passive investing simply aims to match the diversification, the low fees, the relatively low risk, and the overall returns of what we call a broad market index. In other words, passive investors, they basically are simply betting, investing on the growth of the economy as a whole. I believe, at least for me, that this is a far superior approach. Because number one, I know that I don't have the information advantages that professional investors do. And number two, I don't have an entire day ahead of me to think about this stuff every day. I've told you guys in class, I sort of like the crock pot approach. Put everything in, set that heat, walk away, and then eat later. You can think of passive investing, to put it kind of crudely, as a crock pot approach to investing. But it's critical to point out that passive investors, they typically do really well. They do very little trading. They don't buy and sell a lot. And as a result of that, they incur minimal fees and costs and transactions, so they keep more of their money. They have the thinking, because they're thinking long-term growth tied to a broad market, tied to the overall American or international or global economy, whatever you're investing in, they're able to accept market volatility and they don't get bothered by it. And therefore, most passive investors are able to keep their anxiety and their emotions and their cortisol levels in check. Critically, they ignore the financial press. They avoid attempts at timing the market, which research suggests very few people do well. And in spite of all these benefits, they still succeed in the long term. So you're going to have to ask the question number 3, will you be an active or a passive investor? Another question, number 4, what types of investments will you make and what will you avoid? In other words, a part of your investment plan is thinking and putting in writing to commit to it. What are for you acceptable and unacceptable asset classes? Will you invest in individual stocks? Will you invest in currencies? Will you invest in Bitcoin? Will you invest in gold? Will you invest only in America or only in the developed world? Will you invest in emerging economy stocks? There's a lot of options out there. Economics is about constraints. This question requires you to set constraints on where you will deploy your investment capital. What are the acceptable and unacceptable asset classes? Related, that's a 5th question. Will you invest in mutual funds or will you invest in individual assets? Now, there's no right answer to this, but we know that mutual funds typically offer lower fees on top of broader diversity than individual assets do. So you're going to have to ask that question. A 6th question. Sorry about that. A 6th question, will you use leverage in your assets? Leverage refers basically to, if you want to put it really generally, the use of borrowed money or loans or debt as a part of your investing strategy, okay? There's 2 typical ways that investors can use leverage. They can buy on margin or they can engage in short selling. Buying on margin refers to the process of borrowing money to purchase a stock. Short selling, another form of leverage investing, is when you, this is weird, but short selling is when you borrow a stock from somebody and then you immediately sell it. And then, of course, you hope that the market works in your favor and that you can rebuy that stock at a later time at a lower price to pay that stock back, okay? There's people who have done extraordinarily well with margin investing and short selling. Those people are oftentimes professionals. Critically, for all the people that you hear about who did great in short selling and made millions in margin investing, you rarely hear about the people who got wiped out. And that's the trade-off. I strongly advise you to not engage in these leveraged forms of investments, because if you do that, you have a lot of potential downside, okay? Yes, there have been people who have made lots of money using leverage, but there's a lot more people who have been completely wiped out. We just don't hear about them, okay? Another question, this would be question number 7 in your investment plan. What asset allocation will you follow? Another question, question number 8, if you choose to use financial advisors, and you may or may not, but if you choose to contract with and utilize a financial advisor, will you require this person to follow the suitability standard or the fiduciary standard? This is something that amazes me, is not taught more often. But the reality is financial professionals, including those who work for you, they have different classifications of the standard of behavior by which they can operate. One standard is called the suitability standard, and the other is called the fiduciary standard. Under the suitability standard, get this, financial advisors are required to act in the best interest of their employers. And therefore, in turn, they can recommend to you potentially high profit, high fee, high commission investments, so long as they judge them to be suitable for you. Please note, my friends, especially since most of you are econ majors, suitability is not synonymous with optimal. It is possible under the suitability standard for a financial representative, a broker, your financial advisor, to recommend a product to you that is judged to be suitable, even though that product may be high profit for the firm that sold it to you, high fee for you, and high commission for the broker, okay? On the other hand, under what is known as the fiduciary standard, which is really the one that I would advise you that you insist that your advisors follow. Under the fiduciary standard, a financial advisor is legally obligated to always act in your interest. Their decisions, their recommendations are legally required to be in your interest, not in theirs and not in their employers, okay? It is critical that you ask any potential financial advisors, any consultants, anybody else who you arrange with as a part of your financial team, what standard they follow. So anyway, friends, with that, we have a basic outline for an investment plan. So you decide that you're ready to invest. You craft out this investment plan by thinking about these questions, maybe some other questions, and there's lots of free templates online that you can pull to help map out your plan and put it in writing. Once you do that, you're ready to enter the securities market. I want to just talk briefly with you about the securities market so that when you start investing, some of the jargon and terms that you hear, they make some sense, okay? The securities market basically describes the marketplace where stocks and bonds and all these other instruments are traded. They're typically divided into one of two types: primary markets and secondary markets. Primary markets are where new financial assets are issued. The two most common primary markets are the IPO, the initial public offering market. That's where a new firm goes public to issue stock. The second primary market is what's known as the seasoned new issue. Whereas an IPO is when a new firm goes public, with a seasoned new issue, an existing firm that already has publicly traded stock, they simply issue more shares in an attempt to raise more capital, okay? Secondary markets, that's where most of you will operate, because it's in secondary markets where investors like you and me buy and sell existing securities. These secondary markets can be organized broker exchanges like the New York Stock Exchange. They can also be dealer markets like NASDAQ, okay? Fundamentally, at like their technical level, New York Stock Exchange and NASDAQ operate somewhat differently, but the reality is for individuals who want to invest, those differences are really not material. They simply are ways to enter the secondary market to buy and sell, okay? Another component of the overall landscape of the securities market are stockbrokers, who often now go by fancy names like account executive or financial consultant. But like any broker, stockbrokers, and again, they can provide a valuable service. They buy and sell securities on behalf of clients. Some of them also offer their clients different investment advices and information, okay? I bring up stockbrokers though, because when we talk about stockbrokers, we circle back to the idea of fees and commissions, and the idea that one of your responsibilities is to minimize the fees that you pay. If you minimize your fees, you raise your returns. You keep more of your money, and your future you has more liquidity, more asset base, Okay, so I bring up the stockbrokers because I want you to understand how stockbrokers are paid. And they're typically paid in one of three ways, although this is sort of changing now because of market competition and some of the technologies involved. But traditionally, stockbrokers make money on the commissions of the trades that they make, or as a percentage of the assets that you have that they are managing, or as a combination of both of those. It's worth noting that anytime a broker is getting paid on commission, there may be a broken incentive structure, because if a broker is getting paid on commissions, then clearly it's in that broker's interest to trade often. Okay. When we talk about stock brokers, we also refer and talk about the brokerage houses or the big companies in which these things operate. Okay. Again, due to lots of financial innovation, due to technology and advancement, the lines are getting really blurred nowadays. However, traditionally, we can break brokers up into roughly three types. We have, number one, full service brokers. Those are the types of brokerages or individual brokers who, in addition to executing trades, they offer a whole array of services and advice. We also have discount brokers. For many of you, this will be your optimal path. Companies like Vanguard, like Schwab, like Fidelity, discount brokers, they're going to offer several benefits, including low overhead, which keeps their expenses down, and critically for you, low commissions. However, they don't offer a whole lot of service to investors, but that's okay, especially if you opt to invest in passive investments like no load mutual funds. You don't need their advice. You don't need their reports. So you can avoid those. You don't need them and take advantage of low commissions and low overheads. You also have online brokers. This is really a blurred line between discount, but an online broker is typically a discount broker who just has more ways to use technology and electronic methods to execute trades, okay? Anyway, I bring this up because ultimately, when you craft your investment plan, it's really important that you understand how the companies that you work with are compensated, and critically, what fees they charge. Because at the end of the day, you have to watch this. When it comes to fees, I like the expression, you should be throwing nickels like manhole covers. Every fee that you pay eats into your returns. And if there's one thing I want you to take away from the time value of money discussion, it's that even small numbers over time have big impacts. Same thing holds here. Even small fees over time eat into your returns and reduce the amount of money that future you holds. So I want to encourage you to think these things through, to understand how the securities markets work, and to really frame that, both your brokerage and your stockbroker advisor decisions, in large part about fee minimization and cost reduction. Okay? We'll run some numbers in class as a case study, and it may be shocking when you see how fees can effectively eat into your return, and how, depending on the size of the fee, they may even obliterate all capital gain that you make on a trade. Okay, and that's not a good thing. That's basically an opportunity cost that you don't want to bear. Now, if you do decide to work with a stockbroker or a financial advisor, so let's say that as you advance in your life cycle, your asset base gets big enough and you decide to take advantage of professional stock brokerage or investment or financial advisor services. That's fantastic. And it's great if you get to that point. But you must remember that ultimately these people are working with your money. And therefore, and I cannot stress this, it is your responsibility, yours, to do your homework, to ask them questions, to do your due diligence, to make sure they're keeping your trade and transaction costs low, and critically, to watch your money. Yes, Your broker might be working for you, but let's be very honest here. They have lots of other clients, and nobody will ever care about your financial future more than you. And therefore, if you decide to contract with a planner or an advisor or a consultant in these matters, it is critical that you watch out and that you know how to enter it. A part of that due diligence is going to be to determine if the person that you're working with, and I'm using these terms very loosely, these aren't official terms, but is this person of the trusted advisor sort or of the salesperson sort? And again, those aren't, official terms. They're just more, colloquial. But really, you have to decide these people that you're going to contract with. Are you looking at them? Are they presenting themselves as trusted advisors or as salespeople? And either one is fine as long as it suits your needs with low fees. Here's some questions that I put together that you can ask to help you make an informed decision. You may want to consider, especially if people approach you and ask to help you with your investments, right? Especially if family or friends through referrals bring someone in who did great for them and you should also take them on. There's a lot of pressure on that. Here's some questions that you can ask to make sure that you are advocating for you. Number one, you ask this person, are you full-time? Whether they're a broker, an RIA, a registered investment advisor, an FP, a financial planner. Hey, are you full-time? Or is this some moonlighting thing for you? What's your education? And tied to that, what licenses do you hold? There's a lot of licenses and certifications that advanced financial planners go for. They have to go through fairly rigorous education and testing, and a lot of them also have to subject themselves to ethics requirements. So ask them, what licenses do you hold? How long have you been doing this? The question of how long is a really important question. I strongly advise you to avoid any broker or planner who has not been through at least one down market. Markets rise and markets fall. Everybody's a genius when the market's rising. It's when the market falls that you determine who's good and who's not good. So therefore, if I'm making a decision on who to deal with as a part of my financial team, I'm not going to bring on anybody who was not working full time when the last big oh shit moment happened in the markets. For right now, that's right around, our last really big down was like 2007 to 2009. I don't want to deal with anybody who came into the game after 2009 because they've just gone up, up, up. Anybody can do well in up, up, up. I want to contract with the person who survived the bad time. That person's got at least a little bit more knowledge, maybe a little bit more historical knowledge, a little bit more, a little less hubris, a little less pride, we'll say, than the new guy. So again, how long have you been doing this? As mentioned earlier, are you a fiduciary or are you an advisor? What standard are you on? Will you offer me only investment advice or will you offer me full financial planning services? You now know from this course that full financial planning is not just investment advice, it's advice on tax management, liquidity management, the ability to generate cash flow to make prudent refinance decisions, retirement planning, estate planning, all these elements of the broad plan. What companies do you represent? Which gives you a sense of where their potential loyalties and incentives lie. How are you compensated? Even though it's not a formal question for all you English majors out there, I would say, tell me about your proposed assistance. This is a great intro question because from here, you get a sense of what the person asks you in return. If they give you what sounds like a boilerplate, well, you're 27 years old, you should be doing these things. Nope. You want somebody who, when you say, tell me your proposed assistance, you want somebody who's going to say, well, tell me what your goals are. What's your risk tolerance? What's your current financial status? What's your current family status? You want somebody who is going to do the due diligence to figure out what your unique situation is. You don't want boilerplate generic advice. Finally, you want to ask them, do they have clients willing to recommend them? If you are satisfied with those, then feel comfortable making that decision, okay? So we've discussed now the overall context of investing. We know a bit about the securities markets. We know about investment plans. I wanted to offer you, as we wrap this lecture up, a couple of last points. First, I know that investing can be complicated, it can be confusing, it can be jargon heavy, and there's a lot of conflicting advice. So in this bullet, old Roman number 5, I want to offer you 4 long-term, relatively safe, and generally effective strategies. I bring these up not so much that you follow them, although they would be okay to follow, but I want to bring these up so that you have a bit of a framework, of a foundation in mind as we move ahead in our next couple of chapters and study the different financial tools. In other words, as we study stocks individually and bonds individually and mutual funds individually, et cetera, I wanted to give you kind of a broader foundation, a conceptual framework that you can analyze them in. Note again that the 4 strategies I'm going to give you, they are separate, but they do tie together. So what are ways that you can look at your long-term financial future? What's a foundational framework for you? How about strategy 1? Employ what is known as a buy and hold strategy in anticipation of America's long-term economic growth. With the buy and hold strategy, what you do is you buy a diverse mix of securities at your asset allocation, you reinvest any dividends or interest, and critically, you hold those investments almost indefinitely. In other words, you accumulate well thought through investments that can provide you with good, stable, long-term growth and a good rate of return. I like this, this is what I call the crock pot approach. You put the stuff in, you set the heat, you walk away, okay? But it's important to notice that buy and hold, it does not mean buy and ignore. You got a crock pot, you still got to make sure you got some water in there so you don't burn your apartment down. When it comes to your stocks, you're still going to want to monitor your portfolio annually. You're going to want to review those investments. And you're also going to want to always take a look at where your investments are relative to your life phase. As you approach different milestones, you're going to want to make sure that your asset allocations and your investments are correct. Strategy number 2, utilize portfolio diversification. Let's spell that right. Portfolio diversification to reduce risk and volatility. Okay. Portfolio diversification is a very advanced topic with a lot of math behind it in advanced finance, but at its core, it's basically you selecting a collection of investments, building a portfolio from the different asset classes, and critically combining them so that you get both potential returns, but also what they say in the jargon are dissimilar risk return characteristics. In other words, you want to have a balanced portfolio, including assets that behave in different directions based on economic conditions. That way, as the economy goes up and down, you minimize your volatility, you kind of smooth out your return over time. So diversify. Strategy number 3, this is a great one. Use what is known as dollar cost averaging to buy at, in quotes, below average cost. Dollar cost averaging is a specific approach where basically periodically, like every month, you invest, usually automatically through good systems, you invest a fixed amount. Let's say that you know that you can invest $1,200 a year. You say that's $100 a month. and you arrange so that every month $100 is pulled from your checking or savings account into your investment account, and you do it repeatedly, consistently, okay? With dollar cost averaging, again, you systematically invest. And you systematically invest equal sums. And you systematically invest those equal sums at regular intervals. And here's the key. You do it regardless of the price of the investment. The beauty of dollar cost averaging is it totally reframes you on the ups and downs of the market. Lots of investors, when the market tumbles, they get panicky and they get nervous. But imagine you're a dollar cost investor. When the market goes down, that means that that month's contribution buys you more of the asset. When the asset goes up, your existing assets grow. If the market tanks a little bit again, then your contribution buys you more of the asset because you're sending the same amount in every month. And strategy 4, as we've hinted at, use asset allocation to correctly align your investment categories with your time horizon. Now, asset allocation is good for many reasons. One big thing is it helps you control your risk exposure as you move into different types or different phases of your life. In other words, when you're younger, you have more time ahead of you, you can absorb way more risk because you have a lot more time to offset market volatility. If you're 2 years from retirement, or if you have kids one day and the kid's 16 and he's 2 years away from going to college, you may not have that same time frame for that volatility. So you're going to want to shift away from higher risk to lower risk assets. That's adjusting your allocation around your life phase. Now, asset allocation is a popular topic, and I'll link to some articles on it in Brightspace. Oftentimes, financial planners have given rules of thumb to help make something complicated less complicated. The 2 most common rules of thumb for asset allocation are what are known as the 110 rule and the 120 rule. With the 110 rule, the percent that you invest in stocks, you take 120, you subtract your age, and you multiply by 1.25. So take 120, subtract your age, multiply by 1.25. That should be the percentage of your portfolio in equities, AKA stocks or stock mutual funds. And then you put the remaining assets in bonds or cash equivalents, which are lower risk. You also have the rule of 120. The 120 rule, same rule, just different. Same type of rule, just different. With the 120 rule, you take 120 minus your age. That becomes the percent to invest in stocks. And again, the remainder in cash equivalents, and bonds. Okay? These are pretty good rules of thumb. But here's the thing. Because people are now living longer, and especially because in today's environment, interest rates are really low, a lot of the rules of thumb are sort of being challenged, or they're evolving. We're getting new rules of thumb emerging. A lot of these new rules of thumb, they don't go by your specific age. They go by like your age bracket and your life phase. I won't go into this too much. I'll leave it to you to do the research. Just know that there are rules of thumb if you want to use them. And what they're ultimately designed for in the bigger picture is to help you correctly allocate among the different asset classes in your portfolio. And with that said, my friend, we're almost done with this lecture and you're about ready to invest. The one thing I want to end with, Roman number 6, the thing I want to end with is this. Going back up here to the asset allocation, we said that times change. The rules of thumb change. Old ones are kind of killed off, new ones are emerging. Earlier in the lecture, when we talked about we talked about brokerages, we had said that the lines are being blurred between the traditional full service and the discount brokers. There's a lot of financial innovation. You guys, just in your lives, will probably have access to tools that current investors have never even heard of. It's just the nature of financial innovation in a dynamic economy. So what I want to leave you with, my friends, is this. I know that investing can be scary. I've told you not to be intimidated, that you can do this. But I also know that every time a new tool emerges, a new digital exchange is launched, a new thing becomes trendy in financial media, I know that it amplifies the uncertainty that people have. So what I want to leave you with are principles. At the end of the day, the opportunities may change, the tools may change. I would be shocked if you guys in 20 some years, when you're 47, when you're my age now, I would be shocked if you have the same investment landscape that we have today. So what I want to leave you with are some principles, because while the tools may change, while the environment may change, while the potential asset classes may change, principles are forever. So I encourage you, as you move along your life path, as you move toward future you, to this beautiful version of you that will thrive and flourish and do great things and make a great impact, simply bear in mind the principles of successful investing. Okay? Tools change, principles don't. If you get rooted in these principles, you'll thrive in any environment. What are these principles? What do I want to leave you with? It's the following. Number one, always know yourself, know your goals, know your vision, know your mission. Number two, stay diversified. Number three, make low cost, low fee investments. Use tools that have the lowest possible fees. Number four, tied to low cost, make tax efficient investments. We learned in our tax lectures that you never want to illegally evade taxes, but you want to legally use every tool to minimize or delay your tax burden. Okay? Use investments that are tax efficient. Next, always invest for the long term. Don't be caught up in the sexiness and the energy and the chaos of the short-term investing cycle. Those people, they get on the news and they become popular in media, but the true winners always think long-term, okay? Time is your friend, use it. Next big principle, always use extreme caution if you do choose to invest in individual assets. If you choose to buy individual stocks or individual bonds or individual currencies or any individualized asset, be really careful because there's risk involved. There's a lack of diversity. You have a concentration of portfolio. I want you to be aware of the dangers of individual assets. Next big principle, monitor your performance against appropriate benchmarks. There's two operative words here. Number one, monitor. Always review your portfolio annually. When you get married, if you get married, review it with your spouse or maybe even with your kids, okay? Build this into your life. But on top of monitoring, monitor appropriately. Don't compare yourself to the people next door. Don't compare yourself to somebody you saw on the media. Don't compare yourself to the influencer on some shitty social media channel, which will hopefully be obsolete in 20 years, okay? Use appropriate benchmarks. Typically, benchmarks that are tied to market indexes. It's important that you compare and benchmark. It's equally important that you benchmark appropriately. You don't want to compare yourself to some jabroni on TV because you don't really know a situation. And if you take stupid risk in an effort to match that, if you fall for that peer pressure, and it's a really powerful emotion, you're exposed to loss. Do not waste too much energy or money or time in trying to beat the market. You know that I love you. I think the world of you. But if most professionals cannot consistently beat the market, us amateurs, we have no prayer. Only deal with high quality, licensed, and reputable people. Develop, write out a solid investment plan using the steps that we covered earlier and follow it. And finally, in the end, the key to being an adult, remember that in the end, you and no one else has ultimate responsibility and accountability for your financial success. No excuses, right? No malice, no pushing it on somebody else. You, as an adult, as a financially literate citizen, as a soon-to-be member of a family and a community, you have ultimate accountability for your future financial success. Don't be afraid of it. Embrace that accountability. Enjoy that accountability. Think long-term and thrive. Thanks, my friends. Thanks for enduring this long video. In our upcoming videos, we'll be looking at individual types of assets. But with this one, I hope to lay out for you a broad conceptual framework and a way of thinking about this. Take care, be good, and I'll see you next time.